Hi, everyone. Thank you for being here. This is our very first Fairport Wealth Optimal Portfolio webinar. And I'm really happy to have John Silvis, our Chief Investment Officer, to share his thought with all of you and also for all of you to get to know him and his team. Thank you, John, Anika, and Kristen for making this possible. We will make this a Q&A session, and so feel free to ask your questions by unmuting yourself or by typing your questions in the chat box. So John, I'll start off with a classic interview question. Please tell us about yourself and your background.
Sure. Well, I guess first of all, I'd like to welcome you aboard at Fairport. We're all excited about it and really excited to be working with you and your clients. So I think a lot of positive things coming in 2023 and looking forward to it. But yeah, so I have been with Fairport for 22 years. It seems like a pretty long time. I started the Monday after Thanksgiving of the year 2000, and I will tell you how I always remember it. If you're anybody over the age of 50, you'll know this. That was back in the time when we were counting Chads because we didn't know who the president of the United States was going to be. We were still trying to figure that out. So everybody kind of remember that time frame. So I've been with the firm for 22 years. I am married. I have a wife. My wife Lori and I live here in Ohio. We've been here for 27 years, I think, now in Ohio. We have three kids. Two are in college still, and our oldest graduated and actually lives in Florida. So we are experiencing the empty nesters. So we're just starting that phase of life, and we're trying to figure it out. So we take it day by day, but it's going pretty well so far. You know, as I said, I've held several different positions at Fairport. The last probably 12 years, I've been the chief investment officer. So my role at Fairport really is to oversee the investment process. That's everything from the models to the asset allocation to security selection to communications, which we'll talk a little bit about later, and meeting with clients, prospects, and those type of things. A little bit about myself. I'm a CFA charter holder. So if anybody's familiar with that, I've been a CFA charter holder for about 20 years now. Actually was pretty active in the local chapter here in Cleveland. I'm the past president of the CFA Society of Cleveland. Sat on the board there for several years. Outside of Fairport, I sit on a couple different investment committees. I'm actually on the investment committee for the Cleveland Catholic Diocese here in Cleveland. It's about $1 billion fund, and actually chair the investment committee for a private family foundation, about $200 million. So get a little bit of experience on the institutional side of the business as well, as far as that goes. Grew up originally from Pennsylvania, so I'm a Western PA guy. I grew up outside of Pittsburgh. My wife is an Eastern PA person, so she's outside of Allentown. She grew up in Trexlertown, so she's a little closer to New Jersey than I was. But we both met at Penn State, so we're both Penn State graduates. So we're excited about the Nittany Lions going to the Rose Bowl this year. So that's exciting as well. So that's a little about myself. And you know, I'm only as good as the team I have. So I'll be happy to tell you a little about them as well if you'd like.
Oh, please, John. That was actually my next question about talking about your investment team. You know who they are and how you work together as a team.
Yeah. So I think you've had the opportunity to meet them recently, but we have right now. There's two other people on the team. We're actually have an open position we're looking to hire, and hopefully we'll hire that person before the end of the year. But we have one of my coworkers or colleagues, Rick D'Amico. Rick is also a CFA charter holder. He's been with the firm, I believe, 12 or 13 years now. He heads up our fixed income and our what we call our liquid alternatives. And I'm happy to talk about that if you'd like. So Rick's been here for, like I said, 12 or 13 years. He has been overseeing that process, but again, he helps with the asset allocation, communications to the clients. He does client meetings as well. You know, he's been really busy recently talking about cash and cash equivalents out there and what's going on in the market. So Rick's been a great team member, and again, happy to have a conversation with him sometime if you want to do that as well. The other team member I have on the team is Mike Kalinowski. Mike is our portfolio admin administrator. He's our head trader, so he does all the trading within the firm. He's really our jack of all trades, to be honest with you. He also does the modeling for us. He oversees the systems. He also does helps us with portfolio construction and actually doing the trades within client accounts. We tend to block all our trades together, so he works very closely with Schwab and Fidelity and the trading desk there to make sure we execute those and get what we think is a fair and equitable price. So Mike's been with the team, I think 5 going on 6 years. And as I said, we have an open position for another trader that we should be filling hopefully in the next couple of weeks. I would hope as we get into 2023 and get this time next year, we'll have a team of at least 5, perhaps even maybe going on 6, depending on how fast the firm grows. But I always like to say, I'm as good as the team, and we work really closely with Annika and Kristen on the marketing side to really try to get out the message to clients the best we can, and we do it numerous different ways, and I'm happy to go through those if you'd like as well.
Sure. Before we do that, John, can you describe your and your team's investment philosophy and discipline?
Yeah, so we take a global view of the capital markets out there. On the equity side, we look at not only the U.S. equities, but we look at global equities as well. So I always say we define the universe, the investable universe. We have 8 different asset classes. Large, mid, and small cap equities here in the U.S. So your domestic equities, your what we would call the developed international markets, which would be Western Europe, Australia, Japan, the UK, basically industrial type countries, and then emerging markets. And that would be what they used to call the BRIC countries, which would be Brazil, India, Russia, China, but also South Korea, Latin America, Mexico, and those types. So that's how we define the equity side of the business. And then on the fixed income, again, you could break that down into several buckets if you wanted to as well, between treasuries and munis and those type of things. Cash, which is becoming more and more of an asset class recently because of the way the returns have improved on cash equivalents. And again, I'll be happy to talk about that. And then at times, commodities. I will be honest, we don't really haven't invested in commodities in a while, but we have held them in the past, so we do consider it an asset class. And then for those clients, we think it's appropriate. We also have exposure to alternatives, both on the liquid side, which would be your ETFs and mutual funds, but also what would be a little more on the illiquid side. And we've worked with our colleagues at Hightower, and we've had exposure to both the credit investor type investments and the longer term, traditional hedge funds and private equity as well, for those qualified purchasers out there. So that's kind of how we define the universe. As far as the philosophy goes, I think we take a very strategic view of the world. We don't have a lot of tactical moves within our portfolio. If you look at our average client base, I would say it's kind of a bell-shaped curve, from one end to the other. And that high part in the middle is really the balanced portfolio, a 60-40 type of portfolio with 60% equities and 40% fixed income. We also may have an overlay of alternatives in there as well for those clients that can either have the time horizon or risk tolerance for those as well. But again, we look at more from the strategic standpoint. We don't really take big tactical views of the world, and I mean that by saying we don't move the cash on one day and then try to get back in the market 2 weeks later. We don't have a 50% weighting to technology names versus something else. We're not have a huge overweight in industrials versus energy or emerging markets versus small caps. So we tend to take a strategic view. We build an asset allocation for our clients that we think that gives a measured return relative to the risk they're willing to take. And then as far as other components of the process, we try to keep turnover low. We don't have a lot of turnover in our portfolios. We believe that the old saying, it's time in the market, not timing the market. So again, you want to stay well invested relative to your asset allocation. To us, that's really where the advisor comes in, looking at the financial plan, where their cash flow needs are, and trying to come up with a allocation that meets the risk reward that they're willing to take from that standpoint. And then really just trying to keep costs low and rebalancing the portfolios when we think it's appropriate when you have large moves in the market. I will tell you on the cost, we used to be very diligent about trying to keep trading costs low, but as you probably know, with Schwab and Fidelity now, trading costs are pretty much zero. So we kind of won that war, so to speak, but continue to look at opportunities to keep costs as low as possible. And then, like I said before, take advantage of movements in the market we've seen recently, or even back in 2020 and 2021, where you see equity markets move up to maybe sell some of those winners, so to speak, and reallocate those. And we can talk about fixed income relative to where we are today versus maybe a year ago. But I think the other thing that I probably haven't mentioned, we do use a lot of exchange traded funds or ETFs in our models and portfolios. We just think it's the best way to get exposure. Both the cost is low, they have a tax advantages from how they build the wrapper of the ETF. So unless you sell it, there's not a capital gain distribution, and performance relative to mutual funds have been better over time. So really, I wouldn't say we're biased. We just think as we see the world, when we've looked at the holdings, the ETFs or exchange traded funds are probably the best way from a cost and tax efficiency standpoint to get exposed to the market. So we're big proponents in those as well, and we use those in our models as we build them out. And we can also, for those clients that have a certain income level, or I'm sorry, certain equity level, we can buy individual names as well, and we've done individual large cap names and a lot of the blue chip names, you would know. So that's kind of how we view the world, on the big picture. On the fixed income side, really we're looking at credit and durations, kind of the two things that we use to help build out our portfolio.
Right.
We use the AG as our benchmark, the Bloomberg AG, which is kind of the default bond index out there. And Rick, like I mentioned, Rick D'Amico, our colleague, has currently, or really for a while now, have had a little bit of a short duration relative to the portfolio and a little bit higher quality on credit. And that's helped us, which has been a rough year in fixed income overall, but helped us on a relative basis versus the benchmark. So it worked out pretty well. But if I didn't cover something, let me know. I'm happy to circle back. But that's kind of the general thought of how we look at portfolios. We have models, anything from a all equity, what we would call an aggressive portfolio, all the way to someone who maybe perhaps wants nothing but municipal bonds. I don't know the tax structures well enough in New Jersey, but for those people that may want municipal bonds, we can do that as well. And we have some partnerships with BlackRock and a few other people that can really take a more robust look at where you're at relative to your tax needs and build out a nice laddered municipal bond portfolio for those clients that are looking for that.
Got it. Yeah, thank you, John. That's helpful. And I might go back into it to get more details from you. But one question that obviously big question that a lot of people have in mind is what is your economic outlook, and do you foresee a recession? And if so, will it be severe in 2023?
Yeah, that's kind of the big question, right? I mean, I wish I had the crystal ball that could tell me that for sure, but I guess I'll start where we're at today. So I don't think we're in a recession as we sit here in the fourth quarter of 2022. I don't think we're in a recession. There's been some arguments earlier this year if we were in a recession earlier in the year or not. There's the official group out there called the National Bureau of Economic Research, or the NBER.
Mm-hmm.
They're the ones that have the official call as far as when a recession starts and when they end. they tend to be a little late in the process, so we could technically be in one before they announce it.
Yeah.
But I think that's unlikely. So I guess my first thought would be, as we sit here in the last month of the year, I think the economy's still in pretty firm ground. It stumbled a little bit earlier in the year. The third quarter GDP was in 2.9%, if I'm not mistaken. We watched something pretty closely called the Atlanta Federal Reserve has something called GDP Now, which is a econometric model they use. Anybody that's listening can go out and you Google GDP Now. It'll take you right to the site. It's currently forecasting the fourth quarter GDP of about 3.4%. That'll probably change a little bit between now and the end of the year, but I would say it's a good chance we're going to see a 2 or 3 handle on GDP, so a 2 or 3% type finish to the year. So I don't think we're currently in one. So I guess the second question is, or my second thought would be, how do we forecast recessions, and what inputs do we use as we go into 2023? I think my gut would tell you, and you hear it all the time if you're watching CNBC all day long, which I would advise you not to do, but if you are, that there's a high probability out there, or at least a high probability of the prognosticators, that we're going to see a recession at some point. And usually that's because the Fed tends to over tighten, and then you have some type of pullback. I would say it's probably a little better than a coin flip. It's probably a little better than 50% chance that we'll experience some type of recession in 2023. It's probably a mid-year or maybe second half of the year type phenomenon. But I think a lot can happen before that. So for us, the things that we look at to kind of give us a warning or maybe leading us in that direction would be one, the GDP Now, which I mentioned earlier, and so far that's positive. We get research from a group out of New York called Fairport ISI, very well represented macroeconomic research group, highly ranked on the street every year. They have something called their company surveys, and they go out and survey companies, Fortune 500 companies every week, and they ask them how business is doing. If they give a ranking from 1 to 100, 50 being about average, anything above 45 is considered expansionary. And right now that's still about 53, 54, and it's been hanging in there. So, you could argue that the economy is still in expansion territory. If that would drop lower, that's something we would look take concern with. Earnings, we haven't seen earnings drop yet. There's a lot of anticipation they will, but so far we haven't seen it. But my guess is we will see some softness in earnings. Mm-hmm. So those are some of the things we look at. Unemployment rate, again, has to probably get above 4% before recession starts. We're still at 3.7, so we're not there yet. I would, if you're asking on my forecast, my guess is we'll probably see something very mild or shallow as far as the recession goes. I wouldn't say it's a done deal, but I would say if I was a betting man, I'd say it's slightly better chance than average that we'll see something like that as we get into the year. I think, to me, that's more of a resetting process. That kind of helps reset the economy, and I think that sets us up for better expansion going forward. So if we stay in that mild camp, if the Fed really does tighten much further, then I think we have an issue, and we could see maybe a little more prolonged or longer recession. But the equity markets have already corrected about 25% from peak to bottom earlier this year. Mm-hmm. So you could argue that maybe some of that's already built in as far as a slowdown, and that's something we're keeping a close eye on as well. So I don't know if I dodged the question or not, but I think we're likely to see a recession, unfortunately, in the second half of the year, although I don't think it's a foregone conclusion yet.
Got it. And related to that, John, how about interest rates and inflation rates? Where do you see them heading into 2023 and perhaps even beyond?
Yeah, you're asking a lot of crystal ball type questions here. I wish I had one. But yeah, so I think I'll take it one by one. I think inflation has peaked. If there's two things I think that caused the current slowdown and are the pullback in equity markets. I think one was the Federal Reserve being late to the show and raising rates, and two, it was inflation turned out to be much higher and stickier than they thought. If you go back a year, the term was transitory. It was going to be transitory, not that big of an issue. Well, it turned out to be a little longer, higher for longer than most people anticipated. So I do think the good news is we're probably on the back end of both of those things. I think, as far as inflation goes, I think it was June where we saw 9.1% inflation. I think that peaked. We're going to get another CPI number next week. I think on the 13th. I'm not, don't mark that down, but I think we get it next week. It's likely to continue to come down. I think we're currently at 7.7. It's really more important to me and how we view the markets and inflation from the investment team is the month over month numbers, right? So you get these month over month numbers, which if you string the 12 of them together is your year over year number. But really what you're doing on the yearly is you're dropping one off from 12 months ago and adding one on the front, really. So the one you're dropping off from 12 months ago is not that relevant as the one you're adding at the beginning. So the last 3 or 4 months, we've seen inflation somewhere between 0.2 and 0.3. So if you extrapolate a trend of 3 or 4 of those, you're somewhere between 2.5 and 3.5% inflation on a run rate, which is not that bad. So I think we're seeing it come down. I think other things that kind of lead in that is, gasoline prices are down. I can't speak for New Jersey, but I saw gas under $3 here in Cleveland area. So we're seeing that. Some of the materials are coming down. Shipping prices have come down. I wrote a couple other things down here, but the point is you're seeing those things start to come down. We're seeing signs of inflation easing. I think the problem is it's not dropping as fast as probably the Fed anticipated a year ago. So I think there's more to go there, which would then dovetail into the interest rate question. Fed's raised rates 75 basis points the last 3 meetings, pretty aggressive. I think they got aggressive because they started late, got what they would consider behind the curve, so to speak. I think they've caught up here. I would argue that most people now think that maybe they're getting ahead of the curve. But they're going to raise rates next week. 50 basis points is our guess. I think that's pretty much consensus out there. If you look at the CME has, if you go out to the website, the FedWatch website, they kind of give you odds. It's about 75% chance they're going to raise 50 basis points. So I'll go with that. But I think the bigger question is when do they stop and what is going to be what they call the terminal rate, which is the top number. I think they're going to get to 5% on the terminal rate. Some would say 5.5. I don't think we're going to get there. I could argue that 5 is probably too much, but that's not really the case. It's not really relevant. The question was, where do you think they're going to go? So I think we'll see rates rise in December and probably once or twice in the first quarter of 2023. But I think it'll be a slower pace, maybe 25 basis points each time, and the Fed will start to, set the stage for them pausing, probably sometime at the beginning of the second quarter. So that's kind of our best estimate. That's our best guess at this point. The 10-year Treasury looks like it may have peaked already at 4.5, so that's kind of already forecasting that maybe we're close to the end. The short end of the curve looks much more attractive than the longer end of the curve. The yield curves have been inverted, depending on which one you look at. The one we look at the closest is the Fed funds rate versus the 10-year. That just inverted recently. It has to be inverted for about 3 months before it really sends a recessionary signal. So that's something we're also keeping an eye on. But yeah, I think we've seen the worst as far as inflation goes, and I think we're near the end of the Fed tightening cycle. I won't say we're at the end, but I would think over the next 3 or 4 months we're going to hear more and more comments about how we're closer to the end than we thought.
Okay. Great. Yeah. Thank you. That's very helpful. I guess the $64,000 question, and I promised the last crystal ball question. What's your stock and bond market outlook? And I mean, you mentioned about corporate profits and also Fed's actions. Do you foresee both of those driving a lot of volatility going forward, for both bonds and stock market, or we have seen the worst of it?
Yeah. So I think well, no question the volatility was high this year, right? I mean, you go back to, I was just having this conversation with one of our colleagues. You go back to 2017, President Trump gets elected in January, or gets elected in November, has an inauguration in January 2017. Everybody's like, well, this is going to be a really volatile time, and he's going to take on China and all these things. And we didn't have one day in 2017 where the market was up or down more than, I think it was more than 2%.
Mm.
So which says that, very little volatility, right? Now you fast forward to 2022, and we've seen, I don't know what things mean, 90 days or something like that. We're near a record. It goes back to maybe the great financial crisis as far as how many days. So we've definitely seen volatility this year. I think we'll see that kind of continue into the early part of next year till the Fed, we get a little more clarity on the Fed, direction of the Fed. A couple of things that makes me think we're going to see a better than expected year in the equity markets is one, next year is the third year of the presidential cycle, so it's a 4-year cycle. The third year, which would be the year before the election next year, 2023, it tends to be the best year, so that we have a little bit of a tailwind there. We just had the midterm elections in November. 12 months after the midterm elections, believe it or not, are always positive, going back to 1940. So again, a little bit of a tailwind behind you. Now the headwinds are we likely to see a drop in earnings or maybe a flatness in earnings.
Mm-hmm.
We're going to see at least a couple more Fed increases in interest rates. So those are kind of headwinds coming into it. But I think, and I'm probably in the minority here, but I think we're going to see a positive year in the equity markets. I think the volatility that you mentioned will continue, probably more in the first half than the second half. But I think we're going to continue to see some volatility. There's always a possibility we could retest the lows from October. I think that's less and less likely, but again, can't be ruled out at this point. I think a lot of it depends on how severe, if we have a recession, if it's a little more severe recession or average recession, then we could see more volatility in the first half of the year. If it tends to look like it's a very mild recession, then maybe the worst is behind us. But I think, we'll go through 2023 with a lot of movements. I think, the equity markets will finish the year positive. It might be a fourth quarter rally that gets us there. I think we'll see some positive returns next year. But I would buckle up the seatbelt because it's probably going to be a little rough. As far as interest rates go, I already kind of mentioned, I think we're going to see them raise rates at least a couple more times here. 10-year got to 4.5. It's come down quite a bit. I think it's down to 3.5. I don't know if we'll see a retest of that high this year. I think that's unlikely. We only have a few trading days left. Could we get back above that 4% in the 2023? I think we will. But I do think the bigger picture is, this has been one of the worst years for fixed income returns going back several years. I think we'll see positive returns. I tend to think we're going to see a less than coupon return. So if the 10-year has a coupon rate of call it 4%, we'll probably see returns of 2 or 3%. So you'll have some returns in there. Currently, as we structure portfolios, we've been focusing more on the shorter end of the curve. There's attractive yields around 6 months, 12 months, 24 months, somewhere in that range. That's kind of where we've been focusing. There could be a point in time where we want to start to shift to longer term, a little longer duration. If we think rates have peaked, I think we probably make another run at that 4% level, maybe get back up to that 4.5. But I think that's probably going to be the high end of it at this point.
Got it. So on the
I reserve the right to change my mind on this.
Sure, absolutely. Well, that's what we're counting on you, right? To kind of see what the data as it comes along. So sounds like on the fixed income that you may go on the longer duration, obviously keeping the quality, but longer duration. And how about on the equity side? I mean, given all the things that we have talked about, are you
so I think
positioning differently? Yeah.
Probably stay short duration into the year end and into maybe the first half of the year, and then maybe reevaluate. So we'll see on duration. But as far as the equity side of things, it's like I said, it's been a crazy year. It's been very volatile. If you'd asked me that question a year ago, I would say we'd be overweight cyclical names, overweight technology. We've been overweight technology for several years because it's been one of the growth leaders and market leaders. But as we got into early part of the year, the first quarter of 2022, we started to see a rotation in the market, right? So technology names have gotten hit quite a bit. Value started to outperform growth, which hasn't been the case for several years. We've seen defensive names start to outperform cyclical names. So we made a shift in our portfolios earlier in the year. We actually moved to underweight in technology, and when I say that, again, we don't make large moves, but instead of being 2% overweight or 1% underweight, we made a shift there. We added some consumer staples in that area, added some pharmaceutical names, so healthcare names. So we're now overweight healthcare, we're slightly overweight consumer staples, and actually overweight energy. That's probably the most cyclical area we're overweight now, and we're actually underweight technology and consumer discretionary, which again, if you'd asked me 12 or 18 months ago, it would have been the exact opposite of that. So we definitely shifted from a cyclical bias to the defensive bias. And then in some of our ETF models, which are a little more focused just on growth or value, we definitely shifted from a growth to a value tilt early in the year, and that's actually helped us out quite a bit. So that's kind of where we're at today. I guess where we're going to go into next year, I think we continue to see that through year end for sure. I think value looks like it's kind of caught a bid here. I think it's got further to go, so we will probably still overweight value, at least until we get more clarity in the Fed and the direction of the economy, and probably stay more defensive. I think the healthcare names look pretty attractive here. The technology names, although we're underweight, I still like them, but I think there's a little tough sledding to go. I don't think they're going to be market leadership over the next 12 months. Staples, we're overweight now. I could see it starting to fill that back. Same with energy. I think energy's had a good run here. Probably take some profits next year. Our client base has been historically, and I know you and I have had these conversations, pretty tax sensitive. Yeah. We try to minimize taxes as much as we can with gains, and then try to, unfortunately, when opportunity comes up, harvest some of the losses when we can do that to offset the gains. So as we get into next year and kind of reset that calendar, we'll probably look to maybe take some gains in some of the energy names that we've had. But yeah, so I guess the big picture, asking how we're positioned, a little more defensive than we have in the past, a little bit more value than growth, and still short duration, but something we're probably going to reevaluate as we get into the new year.
Got it. Yeah, that's really helpful. Well, certainly I've been going rapid fire with my questions. So, if anyone has any questions, as I mentioned, feel free to unmute yourself to ask your question, or type in your chat box, any of the questions that you might have.
So a good question I have for you, do a lot of your clients, or do they have a need or want for municipal bonds?
That's a good question, John. Obviously, for the taxable accounts, I think that will be, I do have some balance into it, but I don't have any clients who specifically want only municipal bonds. But obviously, we have talked about it a little bit, that the municipal bond market at certain points in history, or in the period, become very attractive, right? On the after-tax basis, become more attractive than Treasury, given the same, or similar credit level. What's your thought on that?
So I think I would suggest, if you really want to get a deep dive into the fixed income, I would suggest having a similar call with my colleague, or our colleague, Rick D'Amico. He'd give you a little more clarity. I know we have actually seen, your point about munis versus treasuries and those things. From a taxable yield, municipals are actually looking pretty attractive right now. If you're in that, depending what tax bracket, or if you're in the higher tax brackets, they tend to look a little more, from a yield after tax yield standpoint, look a little more attractive. So that's something we work with. But the problem with it, these inventories are pretty tight. They're hard to get. The inventory levels out there to get municipal bonds, especially state specific. And again, I don't know if the majority of your clients are in New Jersey or Pennsylvania or what area. So it varies by where you're at. But we've been able to do that. I mean, we have a couple of clients down in the Carolinas as well, and Illinois and Pennsylvania. So we've been able to build out those ladders as well. So it's definitely something I would look at from a tax equivalent standpoint for sure.
Right. That's good to know. Actually, I have one question from, let's say, given the recent FTX debacle, what is your perspective on crypto and blockchain technology going forward?
Yeah, so I saw that pop up. I will tell you, well, a couple things. One, so we're part of a bigger group called Hightower. Hightower has a pretty strict policy on cryptocurrencies, as far as clients and the fiduciary responsibilities and those type of things. So we haven't bought, I'll call Bitcoin or any other cryptocurrencies out there for clients. If a client directs us or asks us, we have some options out there to do that for them. My position on it, it's not something we consider as a core holding or an asset class or something that's in our models. I don't think we intend on putting that in our models anytime soon. It's something from a educational standpoint, we keep up on. We actually had a guy from Bitwise come in and do a call for our advisors just to kind of walk through what are cryptocurrencies, why obviously he's talking his book, but why he likes them and what the use are. I think, again, we're kind of in that educational phase of it. I don't see us adding those to client portfolios or really having any, I'll say short to intermediate change on that. And, as far as FTX goes, I've kind of followed up with it as you probably have, on the news and kind of catch it on TV. It was an unregulated exchange in the Bahamas, I believe. It's those things are kind of buyer beware, right? I mean,
exactly. Yeah. Well, it certainly has.
Fan of government oversight, but in this case, I think you want some government oversight on those things.
Right.
And I think, it's a buyer beware. I think if you're going to invest in those type of assets, it's probably money you're willing to lose, and you're taking a speculative bet. And I'm not arguing it couldn't work out if you catch it at the right part of the cycle, but not something we're looking at, not something we use to help build long-term financial plans for clients.
Totally agree, and it's kind of interesting how the whole interest in crypto has changed, with what happened in 2022, right? And then
there was a time, probably 2 years ago, when there was I think Bitcoin was around 60 or 70,000. I would get questions all the time.
right.
Now that I'm not even sure where it is now, I think it's under 20,000. We very rarely ever get questions about it. I'm sure we will. It's a cyclical thing, and if and when it goes back up, I'm sure we will. But again, as we help clients build out long-term portfolios to help meet their financial plans, it's not really part of the equation for us. Maybe that changes at some point, but I don't think any time in the immediate future.
Agree, and it has such an outsized impact on your portfolio that 5% position in crypto it has a massive impact or potential impact. So I was smiling a little bit because I didn't know if you saw the question from David saying that, so with this new combined talent of multiple high caliber individuals, is it safe to assume my portfolio will double every 7 to 8, 9 years? No pressure.
Well, there's all saying in this business, you never make any guarantees or promises, right?
Exactly.
So, our intent is the long-term view of the markets. Depending on the time horizon you look at, raises, somewhere between 7 and 10% on equities. We've had a pretty good run in 2019, 2020, although that was a very volatile year, and then 2021. So it's not surprising we saw some consolidation this year, probably a little more than most would have expected, but we were overdue for a correction of 10%. And we obviously got that and more. But that being said, our goal is to try to mimic returns at the level of risk that client wants. So a 60-40 versus an 80-20 or 100% equities. But that long-term horizon for equities is somewhere between 7 and 10%. And I don't have any reason why we wouldn't see returns something in that neighborhood going forward. But again, there's no guarantee in those things.
For sure. So John, my last question, how can my clients expect to hear from you or keep in touch with you?
Yeah, so first and foremost, like I said earlier, I'm just part of a team. So myself and Rick and Mike, if you ever, I guess on a client level, if they ever want to reach out or you want to reach out, and put a WebEx or a Zoom meeting together, I'm happy to do those things, and we do them all the time for clients. So anytime they have a question, reach out to you, and you can forward it to me, or they can get my email off the website. Happy to interact any way like that. Mm-hmm. Bigger picture, and Annika can fill me in if I miss anything here. So we work pretty closely with Annika and Kristen on our marketing team. I know you have as well, and we'll probably continue to do that. We work really hard to try to get the data out the best we can. So there's a couple things we do for clients. One, you can go to our website. You can go to we have a YouTube site that has past information on it, but we do a quarterly, what we call town hall, investment town hall. That will be coming up in January, and your clients will be invited. So you and anybody on the call or anybody else that missed this call or listening to it on replay can sign up for that. And we kind of go through a little deeper dive. We'll put some slides together. We'll talk about a lot of the things we talked about today, where we at, how we're positioned, what's changed, what we're looking at on the macro level. So I definitely encourage them to listen into that. That's our investment town hall. We do those quarterly. Monthly, we do a podcast. We just did one recently. We'll do another one here in a couple of weeks with one of our colleagues, Dana Hastings. So she's one of our colleagues. She's another advisor, and she kind of asked us some of the top questions she was getting from her advisor, and myself, Rick, or myself and Mike answered those questions. Again, one of the questions we get a lot now is cash and how do you invest it. So that was one of the topics we talked about. We do weekly social media posts that we'll post out on both LinkedIn, Facebook, Instagram. If I missed one, I apologize, but feel free to go out there and follow us on all those. So your clients have access to any of those social media sites. Please go ahead and follow us, and you'll get alerted. We try to put not only investment content out there, but business owner content, tips for executives, holiday things. I think we even put a cookbook out there once a year. I think just kind of a nice thing to do for clients. So definitely follow that. They'll talk about upcoming events as well. And we do a compass, which also has some things on there. And I'm gonna pause. I know Annika's been silent, but if I missed anything, she'll chime in. But I think that's the majority of it.
Yeah, and actually she put it in the chat, so I think we covered that.
Yeah, definitely follow us, and that's the easiest way. But on a personal level, we're always happy to jump on a call with a client. You can give us a call, or we can do a Zoom, whatever's convenient for them. But if anything positive come out of the pandemic, I think the ability to be able to jump on a call face to face with somebody like we're doing today, instead of setting it up, takes 3 weeks to get the person in the office and get parking. We can do it. So we've been doing a lot of those, and I'm happy to do it whenever.
Yeah.
My comments as well.
Yeah, we really appreciate it, and certainly from my experience, since the first day we met, you have been very accessible, and then same thing with Mike and Rick, who I work pretty closely with as well.
Great.
Yes. So John, this has been super helpful and insightful. So really thank you for your time, and also for Annika and Kristen for making this possible. Any last words, John?
No, I'm looking forward to working with you. I know we've, at least behind the scenes, yourself and I and Rick and Mike have been working pretty closely together, but I'm excited about working with you guys. We got the new year coming up. Happy to engage anyway. As I said, my wife is from Eastern PA, so we make a trip out there every once in a while. So um, we're in. She's in Trek. Her parents or family's in Trexlertown, but we're always kind of out that direction. So maybe we can do it in person someday. But uh, anytime, I'm happy
That
to do
that,
it.
that would be great. Yeah, well, maybe we can do a kind event, a live kind event together, John.
Great.
All right.
Happy holidays to everybody, and really excited about working with you guys.
Great. Thank you all for attending. So thank you again, John and Anika, and have a good night.
Yeah, you too. Thank you. Good night.
Okay.